Hello, everyone. Welcome to our webinar today. This webinar is being presented by the Clean Energy States Alliance, and the topic for today's webinar is Federal Tax Credits, Material Assistance Rules for Mere Mortals. The date today is April 6th, 2026, and we have an excellent panel of guest speakers with us today, but before I pass it over to them, I'd like to go over a few webinar logistics. All attendees are in listen-only mode, so your webcam and microphone are disabled. The chat function is also disabled, so if you would like to submit questions and comments, you can do so via the Q&A panel. We'll be saving about 15 to 20 minutes at the end of the presentations to address audience questions, so feel free to type your questions in as you think of them, and we'll get to them at the end of the presentations. Automated captions are also available. The speakers' bios will be made available in the chat as they're being introduced. And finally, this webinar is being recorded. We will email you the webinar recording within 48 hours, and it will be posted on CESA's website at cesa.org/webinars. And with that, I'd like to pass it over to our moderator for today, my colleague Vero Bourg-Meyer.
Excellent. Thank you, Zareen, for this helpful info and, of course, for helping put together this webinar. Welcome, everyone, and thank you for joining us today. I'm Vero Bourg-Meyer. I'm the Deputy Director of CESA, the Clean Energy States Alliance. For those of you who are new to our work, CESA is a national nonprofit coalition of public agencies and organizations, some of which you can see here on your screen, working together to advance clean energy. For almost 25 years, we've brought together state energy offices, public utility commissions, and really public funders of really kind of innovative clean energy programs, such as state green banks, to facilitate information sharing, provide technical assistance, and coordinate multi-state initiatives on clean energy. So what we do can really be summarized quite simply. We do kind of three core things. We convene, inform, and assist states on clean energy policies and clean energy programs. So convening conversations like today's at the intersection of really policy and practice is very much at the heart of what we do. So now on today's webinar, which addresses one of the most consequential and complex developments in federal clean energy policy in recent memory, and also perhaps the source of the most red tape that I've ever seen in my life. So back in February, the Department of Treasury released long-awaited interim guidance on the so-called prohibited foreign entity rules, PFE, and you'll hear a lot of acronyms today. PFE is one of them, prohibited foreign entity. These rules govern really eligibility for the federal tax credits for clean energy and apply to, among others, to Section 48E and 45Y, the successors to the investment tax credit and the production tax credits, again, among others, but these are the ones that we're mostly focused on at CESA. So understanding these restrictions really is now a necessity, essential for any project owner, taxpayer planning on using the tax credits, as well as for folks that are planning on either selling or buying these credits possibly. So the prohibited foreign entity, again, PFE legislative framework was established by Congress in the reconciliation bill last year. And at its core, the statute really for what we're going to talk about today requires project owners to calculate what is known as material assistance cost ratio, or MACR, MACR, another one of those acronyms that we're going to hear a lot today. And essentially, and in a way that I'm going to summarize, maybe that's going to horrify our speakers because I'm not a tax attorney and they are. It's essentially a supply chain accounting exercise that asks how much of a project's cost can be traced to suppliers that are not prohibited foreign entities, and is that share sufficient to preserve credit eligibility? Now, the threshold for this MACR increases over time, and it sounds straightforward in concept, but as our presenters will show you, there are some mechanics that are not all that simple. Hopefully, or thankfully, should I say, the new interim guidance does provide some interim safe harbors that they will go over, and other tools that are intended to help the taxpayers navigate these restrictions. So to help us make sense of it all, the Tax Law Center at NYU School of Law published a very clear, practical explainer that walks through the rules of the reconciliation bill, as well as the new guidance step by step, including things like what costs to include, what costs to exclude from your MACR calculation, what records you should track, track and what things you should track and what you should keep in your records, how to use the safe harbor tables and other things like that. If there is one thing I would like for everyone here to remember from this webinar is that this resource exists and that you should consult it. I'll put the link in the chat so that you do have it for future reference. It was also in the webinar invitation registration. So I'm delighted really to welcome today's presenters. They are both co-authors of this explainer. Seth Hanlon is a senior fellow at the Tax Law Center at NYU Law, where he focuses on federal tax policy with particular expertise in energy tax credits and tax legislation. He previously was Deputy Assistant Secretary for Tax and Climate Policy at Treasury. And then Kyle Sweeney is a senior attorney advisor at the Tax Law Center at NYU Law as well, bringing deep technical expertise in tax law and regulatory guidance, and was previously an associate, at Covington and KPMG. You can find their full bios in the chat. They're very accomplished tax attorneys, both of them. So I won't go through the entire list of all their accomplishment, but you can take a look there. So together they'll walk us through the guidance and its implications, particularly this question of MACR, material assistance, and then we'll have time for your questions as well, which you should put in the Q&A box as Zareen mentioned. So let's get started. Kyle and Seth, over to you.
Great. Thanks so much, Vero. I'm going to go ahead and share my screen here and we'll get going. And can everybody see that? And does it look okay?
Yes, looks great.
Wonderful. Great.
Sorry, if you just click display settings and click switch presenter and slide view, I think then it'll be more full screen.
That will look better indeed. Sorry about that.
Does that work?
I think it still looks the same. Sorry.
And what about now?
Perfect.
Great.
Now it looks great.
Wonderful. And still looks okay?
Yep.
Great. Okay. Thank you. All right. So before we get started, we just wanted to kind of provide our usual disclaimer that we don't represent any clients or organizations, and that everything in this presentation and all of our resources and materials are for informational purposes only and do not constitute legal advice. So just wanted to get that one out of the way, and we can jump right in. And I'm just going to do one more check with the group. Can everybody see that I've switched to the agenda, or just want to get one more double check?
Yes.
Wonderful. Okay, perfect. So we have a pretty packed agenda for you today. We're going to cover a few general items at the top before we dive into the material assistance notice, including reminders on important dates and the meaning of the taxable year, both for purposes of elective pay and the PFE rules. And then we will jump into the details of the recent IRS notice on material assistance, which is notice 2026-15. One thing I wanted to flag at the top is that we're mostly going to focus on how taxpayers who have safe harbors tables can use the notice to calculate their MACR or material assistance cost ratio. We're not going to go into as much depth on how taxpayers without tables determine the MACR. That could probably be a whole separate presentation in and of itself because there's a whole direct cost determination that needs to be performed. But our recent explainer on our website goes into depth on that issue, as well as provides some slide decks for taxpayers without safe harbor tables. And so that's one resource you can look to if you are needing more in that space. And then finally, if we have time at the end, we're also going to try to get into some review of the PFE ownership rules and some of the nitty-gritty aspects of those rules, mainly because they're central to basically all of the PFE rules. So that is the agenda. I think I'm going to jump right to some important dates and run through those with you all. The first ones we just wanted to flag for this group is, a big one, solar and wind credit eligibility. Just as a big reminder, wind and solar projects have to begin construction by July 4th of this year, 2026, so they have to be placed in service by the end of 2027. And the way to establish beginning of construction for this purpose is only through the physical work test. That means you will be following the newer notice on beginning of construction. That is notice 2025-42. So that's the sort of first big date, right? July 4th of this year, unless you're placing into service by the end of 2027. Second big date, the PFE material assistance rules dates. So that's projects that began construction before 2026 are exempt from the material assistance requirements. And for that purpose, you can either use the physical work test to establish beginning of construction or the 5% safe harbor. And you would be using the old or existing notices, as we call them, Notice 2013-29 and Notice 2018-59. So that's second big date. Third big date are the PFE and ownership and payment rules and when they kick in. Just keep in mind those are not based on the beginning of construction date. Rather, they're based on the taxable years beginning after the OB3 enactment. Fourth big date, domestic content, which may be particularly relevant for this group. And remember that there's a requirement in the statute that governmental and tax-exempt entities have to follow the domestic content rules and satisfy those rules for projects greater than 1 megawatt that begin construction after 2025. And for that purpose, keep in mind that Notice 2024-84, which facilitates claiming those exceptions, including the increased cost and non-availability exceptions, is still in effect. So folks should just be aware that date is now in effect. So projects beginning construction after 2025 have to meet the domestic content rules. And then finally, we just want to flag ground source heat pumps, that there hasn't really been any impact to those. So the ITC for ground source heat pumps is still available for projects beginning construction before 2035. And ground source heat pumps are not subject to the PFE rules. So that's just a quick rundown of important dates. And a few other odds and ends that we just wanted to put out there at the beginning. I'm now going to jump to taxable year because this is something that you hear quite a bit in the PFE rules and also just in the elective pay rules more generally. And so for tax-exempt entities filing an annual return, remember that the taxable year is either going to be your calendar or fiscal year as reflected on your Form 990. For governmental and other tax-exempt entities that typically don't file an annual return, your taxable year is the calendar year or the fiscal year is elected on your first Form 990T. And then for other taxpayers, as you might expect, the taxable year is the calendar year, the fiscal year that they use on their U.S. tax return. Why is this important? Well, that's in part because entities need to know the taxable year for purposes of claiming elective pay. But for purposes of this presentation, the PFE rules also require taxpayers to know the taxable year of their owners, counterparties, and suppliers. And mainly because that determines the date in which they actually have to test to those entities for PFE status. So again, you need to know your own taxable year and potentially you need to know the taxable year of your counterparties and suppliers. We'll discuss a little bit more in depth what happens if you're dealing with a counterparty or a supplier who is not a U.S. taxpayer. They don't have a taxable year that's readily available. The recent notice talks about how to make that determination. So before we dive into the new notice of material assistance rules, we want to just do some level setting on the universe of PFE rules. So here we've kind of distilled this sad and winding PFE universe into three buckets. On the left, we have the payments rule, which mainly covers certain payments and debt issuances to specified foreign entities, also known as SFEs. In the middle, we have the ownership of the taxpayer test, which is mainly looking at whether or not a specified foreign entity owns the taxpayer, which can then render the taxpayer itself an SFE or an FIE, which is a foreign influence entity. And then on the right, we have material assistance test from an FIE or SFE. And what that's looking at is whether or not material assistance from either of those types of entities has been incorporated into the taxpayer's facilities, which can render the facility ineligible for credits. So those are sort of our three big categories. Now I'm going to hand it to Seth to then take us through the new notice and really focus on this big test on the right, which is the material assistance rules. So Seth, I will hand it off to you to discuss the new notice.
Thanks, Kyle. Okay, there's the video. Thanks, Kyle. Yeah, so I'm going to run through some of the things that the notice that came out in February, Notice 2026-15, clarified. It focused mostly or almost exclusively on the material assistance rules, the rules that apply to supply chains, and provide some helpful clarifications that I'll go through and leave some questions unanswered that some of which I'll also discuss. So just to recap, as Kyle said, the material assistance rules apply to facilities and energy storage beginning construction after 2025. And beginning construction for that purpose is under the old rules. So you can use the 5% cost safe harbor to establish beginning construction in 2025 or earlier. And if you do, you're exempt from the project is exempt from the material assistance rules. In broad strokes, the material assistance test is essentially whether there is a sufficient percentage of equipment that is incorporated into the facility or into the energy storage when it's completed, that was not produced by a prohibited foreign entity. So you need a sufficient percentage of kind of good costs. We'll cover what equipment matters for this test in just a second. That was sort of one of the main clarifications from the notice. It establishes this formula that's sort of at the heart of the rules. So you need a material assistance cost ratio that meets or exceeds statutory thresholds. Those thresholds they differ for qualified facilities like a solar or wind project and for energy storage technology. And they rise, each year, depending on when the project's beginning of construction date, again, on beginning construction under the old rules. So just to give a quick example, so if you have let's say you have a combined solar and storage facility beginning construction in 2026. So first you would need to assess the solar and the storage would have separate makers, MACRs. And then, because it's two separate projects. And then, so for the solar, at least 40%, you need to hit that 40% threshold. So the 40% of the costs need to be good costs, essentially. And for the storage, you need 55%. So storage has a higher threshold, as you see sort of throughout those years. So that begs the question, and we can go to the next slide. What parts of the facility matter for this maker calculation? And so the notice clarifies, and this is kind of the most important part of it, it clarifies which inputs matter. So put simply, you essentially need to look 2 levels deep in the supply chain and no more than 2 levels. And so you need to determine what are called manufactured products and manufactured product components. So you need to identify what are the MPs and the MPCs in your facility, and then you need to determine whether those were produced by prohibited foreign entities. This notice and the material assistance rules borrow heavily from the domestic content and concepts there. So the definition of manufactured products and manufactured components is the same from the domestic context. And as we'll see, you can rely on safe harbor tables from domestic content to identify MPs and MPCs and also figure their cost. So I have a kind of graphic there just showing, how you're kind of looking 2 levels deep into the supply chain. So manufactured products, like a solar module is a manufactured product. And the definition of manufactured product is something that's manufactured that is directly incorporated into the facility. And then 1 level deeper is the manufactured product component. So a solar cell is the example of that. It's defined as something that is directly incorporated into the manufactured product. Everything before that, is essentially deemed subcomponents, and the origin of subcomponents. So whether a prohibited foreign entity produced them doesn't matter. So everything to the left of that, the red dotted line, is not relevant for the analysis. And then we're only looking at manufactured products. The domestic content bonus and those rules have requirements for steel and iron requirements, which is like, if something is a structural steel or iron component. And in this context, for material assistance, things that are structural steel and iron just don't factor into this equation at all. So we're only looking at manufactured products and manufactured product components. Okay, we can go to the next slide. Okay, so then the other key thing about the notice is that it provides three safe harbors. They're all optional. But that greatly help facilitate compliance with the material assistance rules. So first, there's the identification safe harbor, and that is you essentially look at tables and it tells you exactly. You look up your type of facility and it tells you exactly what the MPs and MPCs are in that type of facility. So you don't need to use the definition and figure it out for yourself. It's right there in the table. That's available, and like Kyle was saying, some technologies have tables, some don't. The identification safe harbor table is available for solar projects, both ground mount and rooftop. Wind, land-based and offshore, battery storage, hydropower and pump hydropower storage. Then second is the cost percentage safe harbor that basically gives you numbers that default numbers that you can just rely on the numbers in the table and don't have to track the actual costs of the MPCs and MPs and MPCs that go into your facility. You can just use the default costs in the table. So that's like makes it extremely easier to use, to do the calculation. But that's only available for solar, again, both ground mount and rooftop, only land-based wind, and also battery storage. It's unclear when, so there's many technologies like geothermal power, nuclear, offshore wind, thermal storage. So a lot of technologies don't have these safe harbor tables. And I think over time there will be these tables, but unclear when there will be tables that those technologies can use. So right now the safe harbor is only available for those for the technologies that are mentioned there. And then also the third is the certification safe harbor. And so that's if you can rely on a certification from suppliers to determine whether or not an MP or MPC was produced by a PFE. And we'll get into that in further detail in a bit. Okay, so we'll start with the first, we can go into the next slide. The first two safe harbors, the identification safe harbor and the cost percentage safe harbor, which kind of go together. So the first thing you do, and go to the next slide. So go back one more slide So the first thing you do is you have to find the table, the appropriate table for your particular technology. So if you have a solar, ground mount project, you look up that table that's indicated right there. Some of the tables have multiple variations, so there's different columns within that table for solar that has tracking, solar that doesn't have tracking. There's different kinds of rooftop solar projects, so you look up the appropriate one for your type of project. And then I think we can go to the examples on the next page. Okay, so here's the examples, and so this is what the tables look like for land-based wind on the left and battery storage on the right. At the end of this deck, we've also put in the solar tables as well. They're kind of longer, so that's why we use the more simple ones here. For land-based wind, what you do is, there's the table on the left. It's from the domestic content guidance. It might be familiar, from that guidance. And so what you're doing is just finding, what parts of the wind project are MPs, manufactured products, and what parts are MPCs, manufactured product components. So the MPs are listed in the leftmost column. And here you can see there's only two. There's the wind turbine and the wind tower flanges. Again, the steel or iron components just don't matter for this purpose. They matter for domestic content, but not for material assistance. And just in terms of the terminology, the domestic content tables list MPs and steel and iron components. They're called APCs. So that's why that column has from the domestic content table says APC, which is applicable project component. But what you're looking for is the APCs that are manufactured products. And so here for land-based wind, it's just the turbine and the flanges. For batteries, if you're looking at the table on the right, it's the pack, battery pack / module, inverter or converter, and then the battery container or housing. So those are the MPs. The corresponding MPCs, so the components of those MPs, are listed in the next column. So if we're looking at back to the land-based wind table on the left, you can see that the wind turbine has 4 MPCs: the blades, the rotor hub, the nacelle, and the power converter. And then there's also a line for the production of the wind turbine itself. But there's 4 different MPCs. So that's basically it. So you just kind of look up and what MPs and what MPCs you need to track the origin of. So let's move on to the next. Okay. So then, all of this is in service of doing this cost ratio calculation, the MACR, so or MACR. So it's again, it's if you're using the table, the terminology is you have to have the total percentage, which is basically going to be 100% in most cases, minus the total PFE percentage, which is the costs that are attributable to PFE produced MPs and MPCs divided by the total percentage. So it's essentially the total minus the bad costs over the total. But an example might be more clarifying, so we can go on to the next slide. Okay, so for land-based wind, so this is how you use the table. So the domestic content guidance has these default values, and these values represent the kind of default typical cost, typical share of the total cost of manufactured items within this type of facility that are attributable to each type. So, for example, wind turbine blades typically are around 31% of the cost of all the manufactured products within the typical wind facility. So it doesn't matter what your wind blades costs. You can just use the default value and assume that the blades are 31.2%. And so as you can see, this adds up to 100 at the bottom. So what you're trying to do here is figure out, which of those lines you can credit as being non-PFE. And those have to add up again to those thresholds that we talked about at the beginning. So basically you sort of go line by line, and you need to determine, which of these things were produced by a PFE. I think we can go to the next slide. So here's what you do. So this is an example of a land-based wind project, and this is sort of hypothetical just to illustrate how this works. But the wind blades were produced by a prohibited foreign entity. None of the other MPCs were produced by a prohibited foreign entity, but then the wind turbine was produced by putting all those MPCs together, the wind turbine was produced by a prohibited foreign entity. So what you need to do is just go through and add up the good costs and the bad costs. So in this case, the blades would be part of total PFE percentage, and so would the production of the wind turbine. But everything else is non-PFE costs, including the MPCs, the rotor hub, the nacelle, the power converter. Even though the wind turbine was produced, the MP was produced by a PFE, because those MPCs were not produced by a PFE, you can credit those as good costs. So anyway, if you go kind of go through the math here, it adds up to 67.9% of good costs. And so this is an example where you'd be way over the 40% threshold, and this project would satisfy the material assistance test and qualify for tax credits. So another thing the notice clarified is the timing of, so you have to, assess the producers of the MPs and MPCs, and then figure out, how applying the PFE rules. And the notice clarifies on what date, like what's the important date to test the suppliers or the producer's status, to determine whether what you got from them is considered produced by a PFE. And so again, what matters here is the PFE status of the producer, not the direct supplier. So it might not be the entity that you purchased the component, the manufactured product or component from directly. It is the entity that produced it. And then, so then you need to assess that producer based on their taxable year. And the key date is the last date of the producer's taxable year, for the year in which you paid or incurred the costs for the MP or MPC. So there's kind of three things you need to figure out. So let's say you buy an MP from a producer. You need to figure out on what date you are deemed to pay or incur the cost. And for accrual method taxpayers, you're deemed to incur the cost when you're provided the MP or MPC. And then you need to know the producer's taxable year, and then determine the last day of which date, which taxable year your purchase falls into. And then you need to figure out on the last day of that taxable year whether the producer was a prohibited foreign entity. And the certification safe harbor can help determine this. So we can do a quick example of this on the next slide. So this is an example of a taxpayer that's an accrual method taxpayer. It's developing a solar facility. And so it purchases and receives the solar modules in September 2026 from a producer. So we're assuming here the producer is a U.S. taxpayer, and we know that the producer's taxable year ends in June. So what you're testing to know whether those modules are going to be considered produced by a PFE or not is whether the entity that produced those modules was a PFE as of the last date of their taxable year, the relevant taxable year, which is going to be June 30th, 2027. So this is somewhat intricate here, but the notice does clarify how this works. So here's just some miscellaneous other rules. The notice clarifies that the cost safe harbor, that the identification safe harbor and the cost safe harbor you can use for retrofitted facilities as well as brand new facilities. So retrofitted facilities under what's called the 80-20 rule. Essentially, if if there's enough new equipment, enough new costs that you're essentially building, that's more than 80% of the cost of the value of the facility, you can count that as a brand new facility, a facility that's newly placed in service. And so the notice clarifies that for those types of retrofitted facilities, you can use these safe harbors, the identification safe harbor and the cost percentage safe harbor, and you're only looking at the new property that that's part of the added to the facility as part of the retrofit. That the property that's already there doesn't factor into the material assistance analysis. Qualified interconnection property. This is something that's gotten a good amount of attention from the notice. The notice clarifies that so projects under I believe 5 megawatts can claim the ITC for the project itself, whether it be solar or wind or whatever, and also qualified interconnection property. The notice clarifies that you need to calculate, do the material assistance analysis separately for the facility and for the qualified interconnection property. And so then to claim the ITC for the qualified interconnection property, the qualified interconnection property itself needs to satisfy its own maker test. There's also no safe harbor tables for the qualified interconnection property. So that's one area where the notice, a number of taxpayers are kind of disappointed that it's still going to be difficult to figure out how qualified interconnection property can satisfy the material assistance test. And then just a note, so if you're using these safe harbor tables, and there's a difference. So, your project doesn't include one of the particular parts that's listed in those safe harbor tables. You can essentially just disregard that part. And also, if you have something that might meet the definition of an MP or MPC in your project, but it's not in the tables, you can just disregard that. So this is sort of another way of saying that if you're using these safe harbor tables, you're using them as exhaustive and exclusive lists of MPs and MPCs. Okay, certification safe harbor. So any taxpayer, certification safe harbors are used. The identification and cost safe harbor tables safe harbors are only available to taxpayers that have those tables. So the technologies that have those default tables from the domestic content guidance. The certification safe harbor, on the other hand, any taxpayer can choose to use it. It's optional. So it's definitely something, if you can obtain a certification, you'll want to, because you can rely on it. But it's not mandatory. And so, the default rules is just that you need to maintain sufficient books and records to, substantiate any credit you're claiming. So you don't need to obtain these certifications. You can do your own due diligence and maintain records. But you'll certainly want to the extent that you can. And then the notice provides that a direct supplier of an MP or MPC can certify as to two things. So first, it's whether or not the MP or MPC was produced by a PFE, and then the second, let's say you're buying an MP, they can certify the total direct cost to the taxpayer of that MP or MPC that was not PFE produced. That's more for if you're not using the cost safe harbor tables. Okay, we can go to the next slide. So there are rules for the certifications. The first four things here are sort of very, very clear and straightforward. So certifications need to be attached to the tax return where you claim the credit. They need to include the suppliers that's providing the certifications, employer identification number, or a foreign equivalent if they're foreign. Needs to be signed under penalties of perjury, and you and the supplier need to retain that certification for at least 6 years. Those things are clear. Some things that have some nuance and a little uncertainty are that the certification needs to come from the direct supplier from which the taxpayer purchased the MP or MPC. And I'll get into why that's a little bit creates some uncertainty. And then also the statute, the One Big Beautiful Bill Act provides that the certification needs to state either that such property was not produced or manufactured by a PFE and that the supplier does not know or have reason to know that any prior supplier in the chain of production of that property is a prohibited foreign entity. So that's kind of sweeping language in the statute that sort of implies that that the supplier needs to certify that all up and down, all up the supply chain, there's no supplier that is a prohibited foreign entity. But as we'll get to, we think the rules are more practical in this respect. And then the certification can state the total direct costs attributable to all MPs that were not produced by or manufactured by a PFE. In other words, what the good costs are. Go to the next slide. So there's an example in the notice that we read as being, taking a sort of pragmatic and helpful approach. And so the example is, a solar developer needs to certify whether the inverters and the PV trackers in the facility were produced by a PFE. Both of those are examples of manufactured products of MPs. And they get the developer gets a certification from each of the suppliers of those two things, certifying that those things, the inverters and the PV trackers, were not produced by a PFE, and that they don't know or have reason to know that any prior supplier of any MPC in the chain of production is a PFE. So to us, this strongly suggests that the certification only needs to attest essentially that there's a no PFE producing MPCs, but they don't have to go back further up the supply chain and attest to whether there's PFEs or not in the supply chain before that, which makes sense because those subcomponents or prior inputs are not relevant for the analysis. We can go to the next slide. And this is just an example. Maybe we can skip this one in the interest of time, but this is an example of how one would obtain a certification if you're not using the cost safe harbor tables. Let's skip that for now. Okay, so there's a couple, a lot of the notice is very helpful in a lot of ways, very clarifying in a lot of ways. There's a couple places where there's some open questions. So I think first is the timing. So as we mentioned, the key date for determining whether a producer is a PFE or not is the last date of their taxable year. But of course, that's not when you're purchasing the item from them. So the question is, how can a taxpayer, can you get a certification on the day when you purchase the item from them and rely on it for that taxable year? So in other words, rely on it for the fact that they're going to remain a non-PFE for and that their status won't change before the end of the taxable year. I think, until there's more clarity on this. So commenters, including us, have asked Treasury and IRS for further clarification on this. But in the absence of further clarification, it's probably prudent to get, to the best that you can, verification or certification that the producer has remained a non-PFE through the end of their taxable year. And then second, the notice says that the certification has to be provided from the direct supplier. And in other places, the notice makes a distinction between direct supplier and producer. So the question is, who is the direct supplier? For example, if you have a EPC contractor, is that your direct supplier of all the equipment in the facility? And then another question is, are you obligated to get the certification only from that direct supplier, or can you get it directly from the producer itself, which would make sense because that's the producer is the entity that you're actually whose status actually matters. So commenters have asked for further guidance on that, and there's some ambiguity. I think in the meantime, I think what most practitioners are telling their clients is get as much certification, as suppliers and producers are willing to provide, whether it's duplicative or not. So yeah, with that, I'll turn it back to Kyle.
Great. Thanks, Seth. Okay, so that takes us now to tracking exceptions. So what do we mean when we say tracking exceptions, and what are we referring to in this context? So the general rule in these rules is that the PFE status of manufactured products and manufactured product components has to be tracked and individually assigned to each facility, right? Because you're doing a maker for each facility. And so the general rule is that you have to look at the components of that facility, see where they were produced, and figure out their, the PFE characteristics of those components. So for example, if you place into service three solar facilities, you have to determine the maker for each facility. You need to know the specific components incorporated into each one, and you need to know whether or not they were produced by a PFE. But the notice provides two exceptions to this sort of what I'll call general rule, or the general tracking and tracing of components rule. And those two exceptions are the de minimis assignment exception and then the less than 1 megawatt EST average cost exception. So let's take a look at both of those really quick, and we'll see if we can do kind of two simple examples. So let's start with the de minimis assignment exception. Notice 2026-15 basically says a taxpayer can assign components rather than individually track NPs or MPCs of the same type that are incorporated in the same type of facility or EST, as long as the facilities are placed in service during the same taxable year and the direct cost of the MPs and MPCs represent less than 10% of the total direct cost of the facility. So let's break that down a little bit with this example. Let's assume taxpayer here acquires 90 identical printed circuit board assemblies, which are MPCs that the taxpayer is going to incorporate into three identical solar rooftop facilities, and they're going to place those facilities in service in 2026. The taxpayer knows that 30 of the 90 have been produced by a PFE. And so the safe harbor table tells us that for those particular MPCs, right, the printed circuit board assemblies, they only represent 7.9% of the total facility costs, which is less than 10%. So what we have here is identical MPCs being incorporated in identical three facilities, and they're all being placed into service during the same year. They all have a cost of less than 10% of the total facility costs. So we've checked all the boxes for the de minimis exception. What does that mean for taxpayers? So as you look in this picture, that means taxpayer can assign these PFE and non-PFE printed circuit board assemblies sort of freely across the facilities, meaning they don't need to trace where each one actually went. They can just allocate them to each facility accordingly. And so you'll see here we have one sort of example, right? Allocation where maybe taxpayer in this case chooses to assign all 30 of the PFE produced assemblies to facility one, and then for the other two facilities they don't do that, right? They they assign the remaining 60 evenly to each two facilities. And so obviously the benefit of this is that it gives you some flexibility to sort of move PFE cost around, especially on the margin. It's not going to be that significant, right? Because the total cost is less than 10% to begin with, but it does give taxpayers some flexibility. So you could imagine other allocations here. If you wanted to spread it out more evenly, you could spread those 30 PFE produced assemblies evenly across the facilities rather than confine them to one. But that's sort of the basic gist of the rule. I think there are still a few open questions about this rule. And one is that if you're sort of, the examples within the notice really strongly suggest that the 10% is more of a cap, right? Meaning if you're doing this for multiple components, you have to look at the total cost that the multiple components make up. And so it's really more like here, for example, if you were to try to do this for other components in addition to this, you would only have sort of 2% left to play with here because you've already accounted for 8% of that total 10% of the cost of the facility. So again, a few open questions on this one, but this is kind of the general gist of it and its potential use. I'm going to jump now to the less than 1 megawatt exception for energy storage technology. And so let's see what this is doing. So unlike the de minimis exception, this is not an assignment tool, right? So this is not going to involve assigning components to various facilities. Instead, think of this as like an averaging tool. So it allows you to spread PFE cost across multiple identical facilities when calculating your maker. And so this is available for taxpayers who want to do this for the same type of energy storage technology. Each individual energy storage technology has to have a megawatt capacity of less than 1 megawatt. It has to be placed in service in the same year, and you can't be using the de minimis exception that I just talked about. So let's look at, again, a really quick sort of example here. Let's assume that a taxpayer places 20 identical EST facilities in service between January 1st and March 31. So that's in Q1, and then another 40 identical units in Qs 2, 3, and 4, right, between April 1 and December 31. So we've got two different distinct periods. In the first period, let's assume that 30% of the battery cells that were acquired were produced by a PFE. And then let's assume that in the second period, 55% of the battery cells that were acquired and used in those facilities that were placed in service in that second period were also produced by a PFE. So we have two sort of different PFE percentages for battery cells, which are a fairly significant piece, an MPC of these facilities. And let's also assume that no other MPs or MPCs are produced by PFEs during this period. And the table, right, the tables for energy storage systems, which is in table 7.02 of Notice 2025-08, says that the cost value of these things are 26.9. So if you look here in the Q1 period, right, that first period, again, I said we put 20 ESTs in service. You can basically just take that 30% PFE production percentage of the battery cells, multiply it by the value, and without having to, right, go through and trace where the PFE battery cells and the non-PFE battery cells were actually used, you can just evenly apply that across all the facilities when doing the maker, and that allows you to basically just apply sort of an average PFE production percentage to the battery cell cost. As you can imagine, this might cut both ways depending on where you are, and maybe you may actually prefer to assign and track individually PFE battery cells and non-PFE battery cells. But this again is an elective option, so you can choose to do it, you can choose not to. So you would apply the 30% to that cost, and then you run your maker. Same thing with the second period of the year. From April 1 to December 31, you've got 40 ESTs you placed in service. 55% of the battery cells acquired during that period were PFE sourced. And so you can apply that to the battery cell cost from the table and when you're calculating the maker for all those facilities. Again, this is a deeply simplified example compared to what the notice provides, but it gives you a little bit of a flavor of how to use this exception. And I know we are kind of pushing up on time here, and so I don't know that we'll have time to get into the ownership rules. So, Vero, do you want me to hand it back to you for
I think
any questions?
it would probably be good to take a couple questions just to clarify, and they'll have people will have your slides and again all of the resources, the wonderful resources that you have on your website. So maybe let's just get into some questions quickly. So one kind of clarifying questions, because I feel from the types of questions we're getting in the chat that there might be like a big kind of confusion about what we care about. Is it the where or is it the who? Is it where are things produced or is it who is producing these things that we care about?
Seth, you want to take
I
it?
can take that. Sure. So for the prohibited foreign entity rules, it's definitely the who and not the where. So that the thing is, like, these rules kind of they're very similar to the domestic content rules in a lot of ways. The domestic content rules is based on the where. So it's whether or not something is produced or manufactured in the United States. But the PFE rules, it's just who. So things can be produced in the United States by a prohibited foreign entity, because it's it's whether the entity that's doing the producing is owned, or fail some other owned by too much, Chinese ownership, or fail some other PFE test.
And vice versa, is it possible to not be a PFE and have some production in China?
I think basically not. I mean, I don't know if it's theoretically possible, but I think basically not, because I think like an entity would be considered, subject to the jurisdiction of China, and would almost certainly,
Yeah,
yeah,
that makes
be
sense.
considered a prohibited foreign entity.
Right. There's like a principal place of business kind of.
Right.
Exactly. Yeah.
Yeah. Okay, great. On the tables, you have a line there, and by the tables here we mean, or I mean, the tables that are used for the cost percentage safe harbor. The production line that's there, what does that mean? And if I don't know if you can go back to real quick to that table example you had two lines that had several lines were listing components, and then you had a kind of random production line. What does that mean? What is that? Yeah, there you go. You have two up there.
Yeah, so that's a good one. So the production line, it's essentially, so all these, so first of all these are like notional values, right? These are default values. So, but the production line, I think, like the question suggested, it essentially is the labor costs of producing the wind turbine in that case. So if the wind turbine is produced by a non-PFE, so in other words, they're incurring costs to put the blades together with the rotor hub and nacelle, et cetera, like manufacture the turbine as a whole. Those and it's a non-PFE doing that, then that production line will be deemed to be non-PFE costs, and vice versa.
And so, and you haven't talked about the cost, and the hypothesis where we are not using, or the circumstances where we're not using those tables. When and is there a time when someone that is trying to use tax credits for something like solar, like wind, like storage that actually has these tables, why would they do anything else but look at these tables?
It's a good question. I mean, so it's going to be way more difficult, in terms of compliance and, getting the documentation, et cetera, to not use the tables, and you'll have, more uncertainty, I think. But, these tables are optional, so that if you do these tables and you don't if you don't meet the threshold using the tables, but you can calculate it on your own, not using the tables, and meet the threshold, you do have that option. I think that's basically the one reason that you would not use the tables.
Yeah, and the likely scenario there, you'd probably still be using the ID safe harbor. So you would probably use the tables for purposes of identifying the components and then not use the cost parts. I mean, because maybe you get a better result by using your actual direct costs. As Seth noted, probably unlikely, but possible. Oh, you're muted, Vero. I think you're still muted. Sorry.
Sorry. We're at 3:59, so we're really running close to the wire here. I will ask one question that was not asked here. What is the one question that you wish people asked and are not asking you?
So I mean, I could go back. They are asking, but I just to go back and clarify something I said. I think, like, there is uncertainty about whether, if you're a purchaser of your project, and you're purchasing an MP, and you're trying to determine whether that MP and the NPCs within it have to be deemed PFE produced, or any of the NPCs within the MP have to be deemed PFE produced. There is uncertainty about whether, what the certification has to say. There's just like the rule in the statute says, you have to get a certification that says the supplier doesn't know or have reason to know that any, prior supplier in the chain of production um, is a PFE. The notice, I think, in our reading is trying to be pragmatic and helpful in giving an example where the certification only says that any prior supplier of any MPCs within that MP is a PFE. So like we view that as the better reading, but we also caution that it is not crystal clear for sure
Mhm.
from the notice. And we and others have asked for additional clarification on that point.
Thank you. Well, maybe that's the right place to end. To mention that you have, I think Kyle, actually, you're the one who submitted some comments on behalf of the tax law section of the American Bar Association, if I'm correct. And these do go in detail about what is known, what is unknown, and the things that you are recommending that Treasury address in the final version. When can we expect a final version of this guidance? Because these are the rules of the road right now, but they will change or be somewhat clarified in the future. When can we expect that, you think?
I mean, I think in the earliest, like the fourth quarter of this year, I would bet. In terms of the next step would be propose rules, and so I don't think we would expect those until the fourth quarter of this year at the earliest. Although it is possible that Treasury and IRS could choose to issue like more discrete guidance on specific questions
Okay.
before that. They certainly haven't said that they're going to, um, but that is conceivable that they would want to just answer certain specific discrete questions
Mhm.
through some form of guidance before putting out proposed rules on all of these issues, including like the ownership tests and the payments tests and everything else.
Yeah, all of these other tests. Well, thank you so much. I think if people want to submit comments, there is still time, and they can use perhaps your comments as inspiration if they need if they need some inspiration. Thank you so very much for participating today. Thank you for to the audience for your great questions, and we will follow up with the slides and the recording. And have a great rest of your day. Thank you. Thank you.
Thank you.